With the debt crisis behind us, many property investors are now wondering how recent bank failures will affect the property market, valuations, and the cost of borrowing for both new and existing investments. Bank failures and the debt ceiling were two independent problems that converged on investors in May, adding to current uncertainty over a potential U.S. recession later in 23, due to Federal Reserve's 10 straight rate increases since March of 22 in an attempt to control high inflation. The recent failures of Silicon Valley Bank, Signature Bank, and others may have either been an aberration in the banking sector or just the tip of the iceberg. FDIC recently announced a watch list of 190 banks that may be at risk. One reason for this single minded focus on the Federal Reserve on controlling inflation by raising interest rates higher and faster than ever before. The fact that the bank Fact is, the bank loan portfolios drop in value when interest rates rise and suffer an even drop in value the higher and faster the interest rates increase. If banks have not hedged this risk properly, the results can be catastrophic. Despite widespread uncertainty, we can offer some general insights on how banking failures can impact property investors. Number one, access to financing. When banks fail, the sources of debt capital available to property investors are reduced. If the failed banks held uninsured deposits on provided loans, investors may not be able to access credit or funds needed for operations or new investments. Two, reduced bank liquidity. Many banks are reporting reduced liquidity and therefore have less cash on hand to lend. Sharply higher interest rates combined with flatter declining property valuations reduce the value of bank loan portfolios. Cash once available to lend now goes to fund risk based capital reserves. Some banks are limiting new loans to only their best customers or reducing the number of markets they lend in. It's difficult to make new loans when there's uncertainty over a potential drop in the value of the loans already on the bank's balance sheet. Number three, loss of deposits. Investors have deposits in a failed bank that were not insured by the FDIC or exceeded their coverage limits, they could potentially lose their funds and put their own solvency at risk. Number four, uncertainty in market sentiment. Bank failures create uncertainty and negative market sentiment. Property investors grow cautious or reluctant to invest at all, fearing further failures or a weakening financial system. And this leads to reduced demand and market activity, which pulls down property values. Number five, investor confidence and perception. Bank failures erode investor confidence in the overall stability of the financial system. Investors may question the reliability and safety of financial institutions, which could influence their investment decisions. Negative perceptions about the banking sector may lead to an increased risk aversion or a shift in investment strategies. I agree with a recent Goldman Sachs report that reduces the chance of a recession this year to 25%. Quick and decisive action by the FDIC in backing bank deposits and other policies to safeguard the banking system will prevent another banking crisis. The report noted that combined with continued strong job growth and consumer spending, it has lessened the risk of a recession in 23. Their chief economist projects only a 25% chance of recession. Congress and White House found a compromise on increasing the debt ceiling that keeps the U.S. economy and banking system from going off a cliff into uncertain waters. The next potential standoff on the debt ceiling would not be until January 25 after the 2024 presidential election. Now, if you're in need of an experienced commercial real estate broker, I can be reached at 281 222 0433. Appreciate your time and have a good day.